I've often heard of balance sheets referred to as snapshots in time. Using that analogy, the income statement then is the story or the movie of what happens between those photographs taken at different times. So, what does the balance sheet actually tell us? Stick around to find out. Imagine you want to take out a business loan. Your lender might want an estimate of what the company owns that could be used to generate future economic benefit or could be sold for cash if you default on the loan. We call those things assets. Assets are the things we own, and the liabilities and equity are how we paid for those things. Your lender might also want to know how much of the future benefits of the firm have already been promised to someone else. Those external future claims are called liabilities. A formula known as the accounting identity says that assets must equal liabilities plus stockholders' equity. The entire balance sheet is organized based on this formula. A lender could use it to determine the equity value of the company. Imagine your company had $100 in assets and owed $30 in liabilities. That leaves your ownership stake in the firm as $70 in equity. That $70 is the value of what we own that isn't financed with borrowed money. Equity is increased by investors buying shares in the company or when the company retains positive earnings. The bank would know that lending you more than $70 could be very risky. The balance sheet is organized in order of liquidity because liquid assets are safer. Liquidity refers to how easily or quickly the item in question can be turned into cash. The first item listed under assets are the most liquid items. Cash itself is the most liquid of all and is listed first under the assets. Highly liquid investments that are easily converted into cash are the next most liquid assets. Next is the credit you extend to your customers. We call these accounts receivable. Accounts receivable is the total value of sales that you have not yet been paid for, less whatever amount you've determined that you will never be able to collect. After receivables, the next most liquid assets is inventory. You build inventory with the expectation of selling it, but it's hard to sell things. So inventory is less liquid than either cash or collecting the money that your customers already owe you. It's also possible that you might make a formal short-term loan to someone, giving them funds today with their promise to pay you back later. These types of loans are less liquid than inventory because it can be hard to sell the loan that you hold. But the portion of the loan that you plan to collect in the next year is still expected to be converted to cash before the next year is up. So that portion would be called a current asset. To understand another type of asset, imagine that on the 1st of January, you paid your entire rent for the next year. We should space the rent expense out over each of the next 12 months to better match up with the passage of time. Remember the matching principle? After all, at the end of January, we still have the right to stay in the building for 11 more months. The right to occupy the building is an asset, and it needs to be recorded as such until the end of the lease. As time passes, we expense the rent each month until the balance is zero, because we no longer have the right to occupy the building at that point unless we pay rent again. These types of prepayments are considered current assets because while difficult to convert to cash, we expect to reap the benefit during the next year. If you have assets that are not current, they are said to be long-term assets. Those could include property, industrial facilities, and equipment used in the operations of the business. These three are usually consolidated and called PP&E, which stands for property, plant, and equipment. Later, we will talk about the differences between capitalizing something as PP&E and expensing it. For now, just think of PP&E as assets of a significant size that have expected lives of multiple years, so they don't get expensed when they're purchased. You could also have intangible assets that have a long-term value but are not physical in nature. These could include trademarks, copyrights, patents, or even goodwill. Goodwill is the amount you paid to buy a company above the book value of their assets. Other types of long-term assets include the rest of a long-term loan that you've made to someone that will be collected over, say, the next 20 years. As for liabilities, they're listed in order of when they will be due. Remember, we said a liability is the claim of another party on your future earnings or assets. Liabilities that are due within the next year are said to be current. The rest are long-term liabilities. Current liabilities include the money you owe your suppliers for things you bought but for which you haven't paid yet. Other forms of current liabilities include wages that the employees have earned but have not yet been paid, called wages payable. If we choose to take out a formal short-term loan, we would then record the portion due in the next year as notes payable. We could also have taxes that are due and are recorded as taxes payable. See the pattern here? What happens if one of our customers pays us in advance for some work that we agree to perform later? Remember the video on revenue recognition. If we haven't provided the service, we can't recognize the revenue. Somewhere on the balance sheet, we need to recognize both the cash receipt and the fact that we owe someone for a service we have yet to perform. That sounds like a liability. We will refer to that sale as unearned revenue, which is a current liability. Long-term liabilities represent the claims others have on our future earnings or assets that we expect to pay off more than a year from now. These include long-term debt. There are a lot of ways that a company can borrow money, but any amount that is to be paid back more than a year from now should be classified as long-term debt. Remembering the accounting identity, which states assets equal liabilities plus equity, we have already discussed both assets and liabilities, and that now leaves us with stockholders' equity. Equity represents the investment owners have made in the business. It starts with the initial capital they invest to found the business. It then typically grows by the retention of net income. That doesn't mean that we can't ask the equity investors to put in additional financing. We can do that through a variety of means, but equity usually grows by either issuing new stock or by retaining earnings. We've demonstrated the value of the balance sheet to the lender, but it also has value for us. The balance sheet helps us to understand internally and communicate externally the value of our company at any point in time.